Too many people talk about the tax benefits of rental real estate, but never explain how you actually do this on your tax return. Well, today I'm going to go through how you actually claim income and expenses on your tax return and how it typically works for a standard single-family rental property that is cash flowing, and how you can generate a tax loss on your tax return where you have taxable income, you have a tax loss for tax purposes. Now, the property you have and the numbers may be different, but the process and the strategy is exactly the same. I'm Matt Sorensen. Let's build wealth. All right, now I'm going to do a quick example here of a property you bought for $500,000 that you rent for $3,800 a month. Now I'm going to show you how you claim this on your tax return, how depreciation works, what income you have to claim, what expenses can you legitimately take right on Schedule E, and then how this benefits you for tax purposes. So let's break into this example here and let's actually look at Schedule E itself. This is the form that goes on top of your 1040 that shows what happened on your rental property and that claims the income and expense. And you'll see on Schedule E here, there's a place where you identify the property. You list the address and identify the property, and each year as you have this rental, you're going to be hitting that same property in the same area. Now you also designate whether this is single family or commercial. The reason you're identifying this rental property as single family versus commercial is that determines how you get to take depreciation. For a single family rental, it depreciates faster, which gives you a higher expense that you get to take versus a commercial property. So if you got single family rentals, that's a good thing. You get a faster depreciation expense. We're going to come back to that here in a second. Now the next area you're going to see there is the income. You're going to claim the rents received. Now in this example, we said $3,800 a month, which totals for the year rent of $45,600. Now the income is somewhat straightforward. The only thing I would note there is you don't need to list a security deposit. If you've taken a security deposit, that's not rental income, but the monthly rent that is being paid to you by your tenants, that of course is going to be listed there as rent. Now the nice thing about the rest of Schedule E is it gives you the freaking checklist of what you need to put down for expenses. Did you have advertising expenses in renting the property? Did you have auto or travel in visiting the property, showing the property, looking at the property before you bought it, going to manage the repairs or any maintenance that you have on the property? You track that mileage and you take the expense there. We're going to come back to that here in a second. Any commissions you might have had for property management or any leasing of the property, your insurance you have on the property, any legal expenses you had on the property, any management fees you had on the property. We're going to get into mortgage interest and property taxes here in a second, which are going to be some of the big line items. And then of course, depreciation here later on. Now, a lot of people can easily understand, okay, the advertising expense, I listed it on XYZ site to get rented. Okay, I paid the property manager. But let's go to the two big ones I want to make sure you do not mess up. Now, the first one is going to be mortgage. Let's say that when you bought this $500,000 rental, that you got a mortgage for $450,000 at a 7% interest rate. Well, when you're paying that, your monthly payment is $2,625 of interest and $368 of principal when you first start out on the loan. Now, remember, in that payment, only the interest is deductible. The principal is paying down the balance of the loan. The IRS does not give you an expense for that. But the interest, which is the cost of the debt from the bank, you do get to take an expense on. So we want to track that interest. Now, through year one, under this mortgage, according to the amortization schedule, that is going to be $31,355 of mortgage interest. You've got to make sure you take that mortgage interest deduction against your rental income, which again, we had $45,600 of rental income. Now, mortgage interest, particularly when you buy a property and it's new and the bigger piece of your mortgage payment is going to interest, that interest is going to be the biggest expense you'll typically have on a rental property. Now, generally, when you're doing this, a lot of your mortgage providers are going to also track your property taxes, any insurance you might have on the property. But if they're not, you got to make sure you're tracking that as well, because that's an expense you're going to take as well. All right, let's get to the second biggest expense though, and this is the depreciation expense. This one's a little more confusing. You don't get a statement in the mail from your mortgage company saying, here's your depreciation expense. So let me show you how you're going to calculate depreciation and where this goes on Schedule E. Now remember, this was a $500,000 rental property and we get to expense that over time. Now the IRS doesn't let you take the full value of $500,000 because you only depreciate the building. There's a certain percentage of the property that's also land. You don't depreciate the land percentage. Now a common method to take here is an 80-20% ratio to say 80% of the purchase price is building, 20% is land. So in this example, I would have $400,000 of building that I get to take a depreciation expense on. What depreciation is the IRS saying, hey, when you buy something like property or equipment, that building is going to go down in value because things wear and tear, they break down, they need to be repaired. And so that's an expense you get to take over time. Now for residential real estate, you get to take it over 27 and a half years. So for example, you will take 27 and a half divided by $400,000, and that's going to give you the depreciation expense expense you get to take each year. Now, in this example, that amounts to $14,545. Now, keep in mind, you're not paying this $14,545. This is not coming out of your pocket, but you get to take an expense on your tax return. This is the primary reason that you can cash flow, have money in your pocket, and not pay any tax on your rental real estate, is because of the depreciation expense. It is not an out-of-pocket cost. It's this phantom expense the IRS allows you to have in rental real estate or on equipment in a business that decreases the value of the property in the eyes of the IRS. And so they're saying, actually, you get to take an expense for that. Now, your property might actually be going up in value, and generally it's going to be going up in value, but you still get this depreciation expense. Okay, let's start adding stuff up here to see where we're at. We had $31,355 of mortgage interest. Let's say the property taxes were $2,500 and the insurance on the property was $1,200. So that's getting me to $35,055. Now I also get to take depreciation expense. That's $14,545. But what else can I take? What else am I going to take that's going to add up and give me more expenses? Now let's hit some of these other expenses that aren't as large individually, but do add up on your tax return. So we want to make sure we're including them. The first I would say is auto. This is really important for real estate because you're typically driving to the property. Maybe you self-manage this, or you have a property manager you meet, contractor you meet. Maybe you're going to see a tenant or show it. Anytime you're traveling to the property, you need to be tracking that mileage. You get to take 67.5 cents a mile. Let's say you spent 1,000 miles traveling to the property over the first year you acquired it, and as you were renting it and leasing it, that is going to give you a $670 auto deduction because you get to take 67 cents against 1,000 miles. Also, any maintenance expenses you may have, maybe it's cleaned in between a tenant, maybe you have landscaping or other services to maintain the property that you're paying for as the landlord, that's going to be an expense. Repairs, of course, are going to be an expense. Also, maybe you're covering some of the utilities. Maybe the tenant carries some and you carry some. Make sure you're tracking that and expensing that as well. All right, now all these other expenses, although they could be $500 here, $1,000 there, $200 there, they can add up. As you see on Schedule E, there's a lot of options on where you're going to claim those. But let's say in this example, that adds up to $5,000 in additional expenses I'm able to take. Now we're at a total of $54,600 of expenses. Now, this is the big reveal here and the big piece I want to make sure everybody captures and understands about rental real estate. I had $54,600 in expenses. I had $45,600 in rent. I lost money, but did I really? To the IRS, I lost money. In fact, in the IRS's eyes, I lost $9,000 by having that rental property. But did you really? You didn't. You actually made $5,545 on that rental property that year just from the cash flow. Maybe it appreciated too, the mortgage balance got paid down. There's a lot of benefits here, but let's just focus here on the cash flow because I want to make sure you understand. You did not lose money. To the IRS, you lost money. The big reason why is right here. Depreciation, $14,545. That is an expense you did not come out of pocket for, but you get the benefit of on your tax return. This is one reason a lot of people talk about rental real estate being a great tax strategy. I can cash flow, have money in my pocket, and not have to pay the IRS anything because of the depreciation expense, which is a phantom expense I'm not coming out of pocket for, but does get to go on my tax return, which allows me to show lesser income. So what do I actually have now? Well, I actually have a tax loss of $9,000, and that tax loss can be carried forward into future years. Maybe I'm going to use it when I sell the property. Maybe I can net it against other rental properties where I don't have a loss. And also, if you're a real estate professional, you could take that loss to offset your other income, which is another additional benefit on top of being able to cash flow the property without having to pay any tax. Now, make sure you're tracking this properly using Schedule E. Maybe you have a great accountant. Maybe you have a Main Street tax pro that's helping you. Make sure you're using someone that understands you, rental property, small business, so they're taking advantage of all the tax deductions and strategies that help you better build wealth. Now, please subscribe to my channel. We've got tons of videos here on how to save taxes, protect wealth, and build assets. I'm Matt Sorensen. We'll see you next time.